Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 international stock ETFs that may be a great buy in 2023. The US stock market has dominated their competitors during the past decade, and we've seen record outperformance. But many of the world's top asset managers do believe we're going to see a switch in 2023, where international equities begin to outperform. Bank of America has come out with 7 reasons why global stocks are set to crush their US counterparts for the first time in 15 years. Another article from Morgan Stanley outlines 5 reasons where non-US stocks may start to outperform the US market. Fidelity believes we now have to take a more globally diversified approach to investing, and their team sees a prolonged period where international stocks may outperform US equities over the next 20 years. Even BlackRock, the world's largest money manager, now sees a period of time where international equities will outperform the US market, and they predict international outperformance in 2023. So overall, there's many of the world's top money managers and some of the smartest investors on the planet believing that international equities are now poised to outperform the US market going forward over the next year and in the future. So in this episode, we're going to take a look at 3 international ETFs that may be worth adding into your portfolio to get more global diversification. But first, if we go over the research done by BlackRock, we can see that the US market has strongly outperformed during recent history. They've beat the international stocks in 8 of the last 9 years and in 10 of the last 12 years. But this recent history has not always been the case. We've seen prolonged periods of time where international equities have actually grossly outperformed the US market by a significant margin. And if we take a look at every period over the past 50 years, international stocks have performed strongly throughout history, outperforming the US market during nearly half of all the time periods over the last 50 years. And when the US market has returned below 4%, 100% of the time during the past 50 years, international stocks have outperformed on average by 2.4%. And when the US market grows at less than 6%, 60 of the last 64 periods, or 94% of time, international equities have outperformed. So pretty much if the US market returns under 6% in a year, it's highly likely that international stocks would have outperformed during that same period from 1971 through 2021. And if we take a look at all periods, 56% of the time the US market outperformed, and of course the remaining 44% of the time international equities outperformed. So the US market does have a slight advantage over the past 50 years, but it's not as dramatic of a margin that many investors may believe. So international equities do have a strong history of outperforming the market during periods of slow US economical growth. And because of the recent interest rate hikes and all the reduced earning expectations for 2023, this may be a period of time where international equities may see some outperformance going forward into 2023 and 2024. So definitely a period in time in which you may want to get some global diversification into your portfolio. And now we're going to move on to the first ETF that will do just that. And that is ticker VEA for Vanguard's FTSE Developed Markets ETF. This is a foreign large blend fund that has a minimal expense ratio of only 0.05%. And the goal of this fund is to provide a convenient way to match the performance of a diversified group of stocks in the large, mid, and small cap categories located in Canada, the major markets of Europe, and the Pacific region. And this is a passive fund approach that replicates the index. So overall, if we take a look, there is over 4,000 stocks within VEA, so it's a highly diversified fund, and the median market cap is at $33.7 billion. The fund has average earnings growth of 8.7%, and the equities trade with a forward PE ratio of around 11.9 and a 1.5x price to book, and these companies are currently turning over a return on equity of 11.7%. So overall, these funds are consistently growing earnings year over year, which is great to see. And if we take a look at the performance of this ETF, over the past 10 years, it provides an average annual return of 4.85%. So of course, when you compare that over the past decade to the US market, which has grossly outperformed, this is very minimal, but of course, historical returns do not indicate future performance. We're trying to take a look at the period of time in which we're in right now, where many of the top firms do believe future going forward, international equities will outperform, and hopefully this average can go up to a more substantial rate. And if we take a look at the holdings within FEA, 52.7% of the funds are located from Europe, the Pacific makes up 36%, and North America makes up the remaining large chunk at 10.2%. The largest holdings within the fund include Nestle, ASML Holdings, which is a large cap semiconductor company, then Samsung is number 3, followed by Roche Holdings at number 4, which is a healthcare company, and then Shell rounds out the top 5. So overall, VEA is one of the most popular Vanguard international funds on the market. If you're looking to add a small chunk of your portfolio into international equities, this one ETF gives you exposure to over 4,000 companies located all around the world, so definitely worth taking a look at. And now if we jump over into the second international fund, I have ticker IGRO, which is iShares International Dividend Growth ETF. The goal of this fund is to generate income from international stocks that have a sustained history of growing their dividend. They have a diversified equity portfolio that invests in global companies that have been screened for a healthy balance sheet and dividend growth potential, and this fund comes with a minimal expense ratio of only 0.15%. And if we take a look, one share of IGRO gives you exposure to over 400 companies and a starting dividend yield at 2.7%. And since the fund was created back in 2016, their average annual return is at 5.4% per year. And if we go over the fund's holdings, 20% of the fund is located from equities based in Japan, 20% from Canada, 11% from Switzerland, 10.5% from the United Kingdom, 7% from China, 5% from Germany, 4% from France, and the remaining small portions coming from different companies in Europe and in the Asian region. And if we take a look at the different segments of this fund, the largest sector is finance, making up 28%, followed by healthcare at 14%, consumer staples at 12%, industrials at 12%, and then utilities making up 8% of the fund as well. And if we take a look at the individual holdings, Nestle is the number one holding, coming in at number 2 is Norvitas, then Mitsubishi, Roche Holdings, British American Tobacco, Sanofi, Royal Bank of Canada, and then Toronto Dominion Bank. So if you're looking for international equities, but you want to focus on companies who pay a sustained and growing dividend, ticker IGRO is definitely worth taking a look at for more of a dividend-focused international portfolio. And now if we continue on into the third fund that also has international equities within it, this fund is not solely focused on international stocks like we've seen with VEA and IGRO. This is ticker VT, which is Vanguard's Total World Stock ETF. So this is a fund that can be the only holding within your portfolio, and you can generate sustained returns over a longer period of time. This stock owns pretty much every stock in the global world markets from every country all around the world, including the United States. So you are going to get a large majority of this fund within American companies just because of the size of the US market on a global scale. So we can see this is a world stock market ETF. It has a minimal expense ratio of only 0.07%. It invests in both foreign and US equities, and it seeks to track the performance of the FTSE Global All Cap Index, which covers both well-established and still developing markets. So you're going to get both the United States, which are well-developed markets, and some emerging markets in this fund as well. And if we take a look at the fund facts, there's over 9,500 stocks within ticker VT. So one share of this ETF gets you exposure to over 9,500 companies all around the world. The median market cap of this ETF is $64 billion. On average, the earnings growth is 15.6%. They're trading with a 15.3 price to earnings ratio and a price to book ratio of 2.4. And overall, the return on equity generated is at 15.2%, and the foreign holdings within this fund sits around 40% overall. So pretty much when you invest in VT, 60% of the fund is going towards US companies and 40% is going towards international. And if we take a look at the fund's historical performance, so if you want to buy over the past 10 years, for a portfolio, the average annual return still going to get a lot of international exposure, where a majority of your holdings, so of course, this has been driven up based on the strong performance of the US market. But since the fund was created back in 2008, it's grown on average by 6.12% per year. So if you're looking for the most passive investment approach possible, buying VT, contributing into it every single month is doing just that. You're getting broadband international exposure to over 9,000 companies with very minimal effort. And if we take a look at the weighted exposure in the international market regions, we can see North America makes up around 63% of the fund. So that includes both the United States, Canada, and Mexico. That also we have Europe at the second largest chunk, make up around 16% of the fund, the Pacific region at 10.8%, and emerging markets at 10.1%. And if we take a look at the largest holdings, these are pretty much the largest companies in the S&P 500. Just because of their size on a global scale, they're still some of the largest companies in the world. Apple, Microsoft, Amazon, United Health, Tesla, Berkshire Hathaway, Johnson & Johnson, and ExxonMobil make up the top holdings within this ETF. So VT is definitely another name we're taking a look at if you're looking for the most passive and simplified approach to investing and also want some international exposure in your portfolio rather than going for a VOO, which is solely US S&P 500 companies. So overall, you can't go wrong with any of the three ETFs we've gone over in this episode: VEA, IGRO, and VT all give investors international exposure for a very minimal expense ratio, and they've all done a great job of competing with the international markets and giving great returns over a long period of time. So definitely some funds we're taking a look at if you want to add international exposure into your portfolio, and if you believe the research and the studies that show that over the next year or two, international stocks are poised to outperform the US market. Again, we will have to see what happens in the future. No one can predict what's going to happen, but if historical performance have anything to do with future performance, definitely a good period in time, or maybe right now a great period in time, to add some of these international funds into your portfolio. Currently, I do not have any international funds within my personal stock portfolio, but I may give a small 5 to 8% allocation for one of these international ETFs going forward over the next few months. And if I choose to do so, I will definitely update you and let you know which fund I choose and how much capital I contribute into that ETF when I do. So thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.